Okay, if you're tracking the housing market at all right now, you know there's one number everyone's glued to, and that's the mortgage rate.
It's been quite the focus.
Right. After a pretty stressful period, rates have actually eased back a bit from those really high peaks, and the market buzz, it shifted almost overnight.
It's silly.
So the big question we're hearing everywhere, whether you're, a homeowner just curious about your equity or maybe you're actively looking to buy, it's pretty simple.
What does this actually mean?
Yeah. What does this rate shift really mean for home values? And maybe, is this the moment? Is a window opening up?
It's the core question.
Okay, let's unpack this. Our mission today is really to get past the headlines. We've dug into sources on interest rates, affordability, market dynamics.
How to data points.
Exactly. To give you the real story on how home prices actually react when these rates move.
Yeah.
Think of this as your shortcut to understanding that whole complex dance between demand, supply, and what we call seller motivation.
And what's really fascinating here, I think, is that while, lower rates mathematically mean more buying power.
Right. Simple math.
It gets complicated really fast. You've got these big factors like how much housing is actually available locally, and then how many current homeowners are just staying put.
Inertia.
Big time.
Yeah.
So if you only follow the national rate news, you're going to miss the full picture, the local picture. We'll show you exactly how this rate leverage works, but also, crucially, where those local factors really take charge.
Okay, let's start with the basics then. The fundamental mechanics. Because interest rates, they really are the engine driving demand, right? They hit affordability directly.
Absolutely.
So if affordability improves, demand goes up. How exactly does that math work for, say, the average buyer out there?
It's surprisingly direct, actually.
Yeah.
Lower mortgage rates impact a buyer in one of two main ways. Either they lower the monthly payment you need for the exact same loan amount.
Okay, same house, less cost per month.
Or, and this is often the bigger deal, they let that buyer borrow significantly more money while keeping that monthly payment target they had fixed in their mind.
So it's like an instant injection of purchasing power into the market.
A massive one, yeah. Immediate.
So, okay, more people can afford to buy, demand rises, basic economics 101. But if the supply side, the number of homes actually for sale, if that stays low,
which it has been in many places,
then that demand pressure just pushes prices up, right? It translates directly into higher home values. We've seen that happen again and again.
It's a consistent pattern. And conversely, if rates spike up,
the whole flow reverses instantly.
Pretty much. Affordability gets squeezed, demand just softens almost immediately because fewer people can qualify for that same house.
Right.
And price growth slows right down. Or the market might even just, flatline for a bit. The link between rate moves and buyer activity is incredibly fast.
Now, here's something really interesting, especially for maybe the investors or just folks wanting to understand valuation. Rates affect more than just the monthly payment, don't they?
Oh, yeah, absolutely.
Even from a pure valuation standpoint, like for investment properties, lower rates actually reduce the discount rate or the cap rate.
Exactly. That's a key point that often gets missed in the day-to-day discussion. Think of the discount rate as like the expected return an investor needs. It reflects risk, sure, but also the cost of borrowing money.
Okay.
So when that cost of the interest rate drops, the discount rate naturally goes down too.
And that means?
Well, if you're calculating the net present value of a property's future income, like all the rent you expect to get, when that discount rate is lower, the present value of all that future money is mathematically higher.
Wow. So just lower rates make the asset itself look more valuable on paper, even before any buyers show up.
Correct. It's not just about what a buyer can afford month to month. It's also about the fundamental asset value calculation. It works on both levels.
A dual lever system. Okay, now let's talk specifics about the recent shifts, because the leverage we're seeing now, it's kind of astonishing.
It really is.
That data point about leverage. Rates drop just a little bit, but affordability jumps a lot. Why is that effect so magnified? It feels almost counterintuitive.
It does sound massive, but it's just the pure math of a long 30-year mortgage amortization. Think about it. Those early payments are mostly interest.
Right, very little principal at the start.
So any reduction in that interest rate, especially early on, saves you a disproportionate amount of money over the life of the loan, which lets you borrow more upfront for the same payment.
Okay, so what's the number? What are the sources saying?
This is the really critical figure.
Yeah.
A drop of about, say, 0.5% in the mortgage rate. So
Right.
0.5%.
Yeah.
That can translate to roughly 5% more buying power. So you can afford about 5% more house, assuming, income and everything else stays the same.
5% more house from just a half-point rate drop, that is staggering leverage.
It's huge.
Yeah. So for anyone tracking their purchasing power, that's the number to really watch. If your monthly payment budget is fixed, that 0.5% drop could suddenly put you in reach of maybe a better school district or that extra bedroom you thought was impossible just weeks ago.
Exactly. It's an immediate boost, both in confidence and actual financial capability. If you are in the market, now's definitely a time to reassess because your dollar, or maybe more accurately, your debt, it just stretches further right now.
But, okay, this leads to the big but, doesn't it? If rates drop, affordability jumps 5%, why aren't we just seeing home prices nationwide automatically shoot up 5%? Why isn't the inventory problem magically solved?
Yeah, that's the crucial point. Lower rates alone are definitely not a silver bullet, not even close.
Okay.
They create the potential for price growth, absolutely. But that potential immediately runs into, well, basically 3 major complex roadblocks. Constraints.
Thanks, drop number 1.
Simple. Supply, or lack thereof. In markets where inventory, the number of homes for sale, is already super low.
Which is many markets.
Yeah, right. That upward pressure from lower rates gets concentrated on very few homes. And what happens then?
Bidding wars. Aggressive price hikes.
Immediately. The impact is much stronger, much faster in those tight markets.
Okay, supply constraints. What's constraint number 2?
This is one that national headlines often gloss over. You absolutely have to consider local economic conditions.
Ah, right. It's not just about the borrowing cost.
Not at all. National rates might drop, making loans cheaper, but that won't matter much if, say, your town's biggest employer just announced layoffs.
Good point. Local job security trumps national rates.
Precisely. Or maybe local property taxes just spiked. The increased affordability from a rate drop might get completely wiped out by local economic uncertainty or policy changes. You have to look at both national finance and local reality. Local always wins at the end of the day.
Okay, local economics. Makes sense. And the third constraint, this feels like the big one everyone's talking about.
It really defines this current era. Seller motivation. Or maybe more accurately, lack of motivation. The lock-in effect.
The golden handcuffs of the 3% mortgage. We all know someone, right? My neighbor literally calls his 2.8% rate his financial anchor. He's not moving.
And he's probably right, financially speaking. So many homeowners either bought or refinanced when rates were, historically low, rock bottom.
2s and 3s, yeah.
They are just incredibly reluctant to move up, down, sideways, whatever, because doing so means giving up that beautiful low rate.
For a new one, even if today's rate is a bit lower than last month, it's still way higher than their current one.
Exactly. Trading a 3% for maybe a 6%, that's a massive jump in monthly cost, even for the same size house, let alone moving up.
So that unwillingness, that financial calculation, keeps overall supply really tight. The buyers might have more power, but the sellers just aren't putting their homes on the market to meet that demand.
Which absolutely mutes the effect of lower rates on the number of listings available. It's a huge factor.
Okay, so this brings us to some takeaways. For existing homeowners, what's the advice here, even if they aren't planning to sell?
Yeah, regardless of your plans, it's always smart, but especially now, to just check your home's value periodically. Stay informed about your equity position.
Knowledge is power, even if you're staying put.
Absolutely. Knowing your improved financial standing might open up other opportunities, like maybe a home equity line for renovations or something else entirely. You don't need to be listing to understand your options.
Good point. And for those sellers who are actually thinking about listing, let's connect this back to them. If more buyers are out there because of rate drops,
They are definitely in a stronger position, generally speaking. Demand is rising to meet them if they list now. More eyeballs, potentially more offers.
but there's a catch, right? Timing.
Timing is critical. Yes, you benefit from higher demand as a seller, but if values are rising quickly because of that demand,
Waiting might mean you pay more when you turn around and buy your next place.
exactly, it's a really tricky trade-off. You sell high, but you might also buy high.
And this is where that analysis you mentioned comes in, the move-up cost analysis. What are people missing when they think about that? It's not just the sticker price of the next house.
No, not at all. That analysis is so important. Sellers, especially those locked-in ones, they need to factor in not just the usual transaction costs, commissions, closing costs,
Right.
but really 3 big financial pieces.
Right.
First, the actual increase in their monthly payment. Going from, say, a 3% rate on their old loan to maybe a 6% rate on a potentially larger loan amount for the new house. That difference could be huge,
Hundreds, maybe thousands more per month.
easily. Second, Potential tax implications.
Hmm.
If you've got a lot of equity, selling might trigger capital gains taxes you need to plan for.
Ooh, good one. Often forgotten.
And third, maybe the hardest to quantify, but very real, the opportunity cost. What else could you have done with the money you'll now spend on higher interest payments? What financial goals are you giving up by losing that low rate? For a lot of people, when they actually run the numbers and see they might pay hundreds of thousands more in interest over the life of the new loan, that often seals the deal. They decide against moving.
That makes total sense. The emotional draw of a new place has to overcome a pretty significant, very concrete financial hit.
It really does. So, okay, let's connect all this back to the bigger picture. Market strategy. These rate shifts, they create this immediate moment, an opportunity, really, to review where you stand.
Whether you're buying, selling, or staying put.
Exactly. And for everyone, it's vital to watch those local metrics we talked about.
Right, not just the national news.
Definitely not. Look at local inventory levels. How many homes are for sale in your neighborhood? How long are they sitting on the market days on market? And crucially, what's the list price versus the final sale price? Are homes selling for over ask?
Because if rates are dropping nationally, but your local supply stays tight.
You should expect competition to heat up fast.
Right.
Higher list prices starting out. Quicker sales. You need to be prepared for that specific local dynamic.
And for the real estate professionals listening, how should they approach this moment?
The smart strategy is to segment your database. Look closely at maybe long-time homeowners, people who've been in their homes 10, 15, 20 years, or those with significant equity built up.
Because the rate shift might be the nudge they need.
It just might.
Yeah.
Especially if they also have, say, changing family needs, kids leaving, needing to downsize, wanting to be closer to grandkids. The rate lock is strong, but sometimes life changes are stronger. This rate dip might finally make the math or the motivation work for them.
So the messaging needs to be careful.
Very. It's about crafting messages around urgency and opportunity, but without sounding alarmist. Things like, rates have eased, creating a potential opportunity, let's review your equity and explore your options.
Focused on education, not panic.
Exactly. It's about clearly explaining the leverage from lower rates, but also being realistic about the constraints, the local inventory issues, the seller lock-in effect. Give them the full picture.
Okay, so let's try and summarize our deep dive today. We've basically established that lower rates, they immediately boost purchasing power. That 5% affordability leverage is real.
Very real. And that directly fuels demand.
But that upward push on home values isn't automatic across the board. It gets checked, sometimes hard, by local supply conditions and, maybe most importantly right now, by that seller rate lock-in effect that's keeping inventory so darn tight.
You got it. Lower rates definitely bring opportunity, no question. Whether you're a homeowner just checking your equity gains or a buyer who can suddenly afford a bit more house.
There are possibilities opening up.
Yes. But they are not a silver bullet. They don't magically fix the entire housing affordability crisis or the inventory shortage. The core tension, the real challenge in the market today, remains that tug of war between slightly better affordability and that stubbornly low inventory, largely driven by homeowners holding on to those ultra-low rates.
It's a complex picture.
It is. Which leads to maybe a final thought for you to consider. We know now that even a small, like 0.5% rate change has this really significant impact on buying power.
That 5% leverage.
Right. So thinking beyond interest rates, what other kind of shift, maybe microeconomic, maybe regulatory, what else do you think could actually unlock housing supply more effectively? What could realistically incentivize those homeowners sitting on 2% or 3% rates to finally make a move, maybe more so than just a dip in current mortgage rates?
That's a really interesting question to chew on.
Something for you to mull over as you watch how your own local market responds this week.